Prateek Agarwal joins us, represents SK Wealth Managers. Prateek, good morning. Thank you for joining us. What is your market view at the current juncture, given the odds we are stacked up with US elections, earnings, where economy is headed? Do you think the risk-reward ratio is favorable?
So we have had a good strong rally from the bottom. We are a few percentage points from the earlier highs. I think given the fact that this is close to end of the year where institutional flows would peter off, I do believe a good case to expect over the next 1 to 2 months is a consolidation of the market in and around the current levels.
Okay. What has been your strategy in last couple of months? Are you fully invested? Have you churned your portfolio? Where are you picking your spots and where are you peeling some gains?
Yeah, so we have had more than usual churn changes in our portfolios. What we have done is to increase weightage of spaces which we believe will benefit from the situation on the ground, both in the present and deep into the future. So we have, for example, increased exposure to technology platforms, technology services. We have increased exposure to pharmaceuticals and chemicals, and even to insurance space. And the most of the monies have come from reduced exposure to the consumption space, which once again, in terms of positioning, in terms of ability to grow, is nicely positioned. But maybe in terms of risk reward, mainly in terms of reward, we thought the other spaces do stack up better. So that's all that we have done.
Okay. There seem to be two aspects to how you're looking at the markets. One is domestically, the rural theme and so forth, and we'll come to that in a moment. But on the other hand, you've also talked about the increased globalization and how there is a need to provide access to that. Talk to us about that, thought process, Prateek, and what then you feel is directly in the line of fire, and what you feel should be, priority-wise on top of one's portfolio.
Yeah, so one trend that we are hearing, we are picking up, is that most of the buyers going forward would be adopting a China plus one strategy in spaces where India has a huge competitive advantage, particularly in chemicals, pharmaceuticals. The companies in India do stand to gain quite a bit from this move, and that's behind our thought of increasing weightage there. Plus, of course, in pharmaceuticals, even the domestic side should deliver sustained growth, particularly in the chronic therapy. IT is not exactly the globalization theme. It is more to do with the fact that businesses would be more okay to offshore work to India rather than getting it done in the US, given that now even in the US people are working from home. And by extension, that home could be a small town in India. So we do believe this is a structural change that could persist even after COVID happens. And that has good, nice, positive margin implications for Indian IT.
Okay, fair enough. And in terms of, you touched upon consumption, but other than that, in terms of the more micro themes that do seem to be playing out right now, how bullish do you continue to be when it comes to the rural segment, when it comes to some of the other more domestic focused themes that are playing out?
Yeah, sure. So rural demand continues to be very strong. This would be the space that will do very well this year. We have some exposure there, but we have not gone overboard rural theme because per se, over a longer period of time, rural businesses can grow at a significantly smaller pace versus other businesses. So while we do have some insecticide, pesticide exposures, we have not gone really whole hog. We do believe even the consumption space that we are invested in is benefiting strongly from the rural uptick in demand, and we are content to play it that way. In terms of the themes that we spoke about, insurance, chronic pharmaceuticals, IT, chemicals mostly on China plus one buying strategy, technology platforms, and that's a big change that we are looking at India. And the other space, a very micro space, if I can talk about. In financials, we do believe as things normalize, that's a part of the market which is significantly lower than the peak seen in January. It is a large part of the market. As normalization sets into the economy, we do believe this is a space where the NPA fears would recede and we could see a significant amount of outperformance. The caveat there is we should not have a second spate of lockdowns on account of second wave that we are already witnessing in Western world. In financials, a good, nice combination is presented by actually gold financiers, and we do have some exposure there.
All right, fair enough. Prateek, in terms of the kind of period we're entering into, we're in the thick of earnings, of course, and we're watching out for some of the key earnings coming out. Most of the data seems to be indicating so far, I mean, apart from some exceptions here and there, but there has been some positive commentary coming in. Are you continuing to see perhaps a slightly uncertain period, let's say for the next couple of quarters, as we sort of see the dust settle, understand exactly where we're at, particularly in terms of financials, or would you say we're well on track when it comes to the recovery?
So I would believe we are on track. If we get out of our homes for even daily chores, the traffic is high, the markets are full. There seems to be a lot of activity. The expectations are Q3 GDP would be nearly flat versus last year. Q4 would deliver growth. If you look at quick indicators, we are looking at a very good season for autos in the festival period. Look at it like this: if Q3 is flat, Q2, while that would be a negative GDP growth quarter on earnings, it may just turn out to be flat. As of now, as you said, the delivered earnings are slightly better on an aggregate basis versus expectations. So Q3, you start to get earnings increase with a flat GDP. Q4, the base itself is low. And then deep into the next year, you have this low base of Q1, Q2 to support earnings growth going forward. So, you need to be sure of what you are looking at. If you're looking at YOY growth, now for 4 quarters, you are going to get good YOY growth. So idea is to stay positive on the Indian economy, on Indian markets. Yes, flows matter. End of the year, we have this issue of people going homes, and for example, FII flows drying up in the month of December. So markets could consolidate for some time, but otherwise the uptake is real, and we need to believe into it. In fact, in financial 22 is the first time when we believe index EPS will cross 500. We have been in the 400s for 7 years. We would cross 500 and in all probability be somewhere between 550, 600 kind of levels for the Nifty EPS. I think with time, market starts to reflect that, supported by lower, of course, interest rate and good liquidity situation that is prevalent. And we do believe there is every chance that valuations sustain where they are for some time and edge up as people see more of the earnings sustaining and coming in.
Sure. Prateek, great to have you on the show. We'll let you go on that note. Thanks as always for joining in. By the way, what looked like it's going to be a quiet start has taken a turn in the negative. We're down about almost 50 points.